The first standard of fieldwork of the 10 generally accepted auditing standards states, the work is to be adequately planned, and assistants, if any, are to be properly supervised. In other words, planning is not something an auditor may choose to do. Planning is a required element of every audit. Planning is required by what we refer to as GAAS, or Generally Accepted Auditing Standards. When an auditor accepts an engagement to audit a client's financial statements, they are agreeing to do two things. 1. Follow GAAS, and 2. Give an opinion on client's financial statements. Step performed. 2. Will teach you the steps to perform to provide the adequate and need to find an overall strategy for the audit. The primary reason the auditor must plan the audit is to determine the nature, timing, and extent of the audit tests to be performed. What does this mean? The nature of the tests to be performed is referring to the two types of tests an auditor performs. During planning, an auditor decides between performing tests of controls or substantive tests. Examples of tests of controls include those tests designed to test the authorization of a transaction, the security of the goods held in the warehouse, or the number of signatures required for checks issued for large cash disbursements. Notice that tests of controls test only policies and procedures. They are not testing the dollar balance of a particular account. Tests of controls are the subject of the Module 2 CD, Internal Control. However, at this point, you must understand that tests of controls test the design and operating effectiveness of a control. They are optional. An auditor may choose to perform tests of controls or to skip them. They are a cheaper test than substantive testing. The general idea is this: if a client is using effective internal controls, they are probably more properly reflecting and presenting the dollar amounts on their financial statements. Stronger internal controls often lead to better financial reporting. While tests of controls are optional, substantive testing is required by GAAS. Examples of substantive testing include analytical procedures such as ratios, comparing account balances, and regression analysis. In addition to the analytical procedures, substantive tests include tests of details, such as recomputing the net present value of a lease, confirming accounts receivable, or conducting a search for unrecorded liabilities. All substantive tests use and test dollar balances. Think of substantive tests as the S tests, or a big dollar sign. Substantive testing is the topic of Module 3, a CD recording dealing with obtaining audit evidence. For now, we are discussing the types of tests so that you can recognize what the saying, determine the nature, timing, and extent of tests to be performed means. The nature of the tests refer to the tests of controls or substantive tests or a combination of both. The timing of the tests refers to when the tests might be performed. An auditor usually chooses among 3 time periods. 1. Interim testing, or in other words, testing before the balance sheet date. 2. Testing on the balance sheet date, which means the last day of the client's year-end. Or 3. Testing after year-end. Keep in mind that an auditor may be appointed to audit after year-end. However, if they are, certain procedures may be difficult to perform, such as observing the year-end physical inventory. Finally, the extent of testing refers to how much testing. The auditor, based upon his or her professional judgment, determines the amount or extent of testing. There is nothing written in the auditing standards that declare the exact amount of testing to be performed. To review, the nature of the tests refers to what kind, tests of controls and or substantive tests. The timing refers to when the tests will be performed, and the extent refers to how much testing. The auditor plans the engagement because planning is required by GAAS to help determine the nature, timing, and extent of the test to perform. Now the overview. It's time to learn things. We know planning is the step of an audit. However, following the audits is been audited. The first consideration is whether an account can be audited. It is referred to as auditability. There are factors as audit to audit a client. 1. The client must maintain adequate accounting records. 2. The client must allow the auditor to understand the internal control process. And 3. The client must believe that the client's management maintains an acceptable level of integrity. An auditor must rely on the client's representations throughout the audit. If you cannot trust management to make honest statements and representations, then you cannot audit the company. Please know the 3 factors of auditability. These factors could be part of an essay or tested in a multiple choice question. Before an auditor can begin the audit, he must obtain knowledge of the entity's business. The auditor obtains knowledge to plan the audit and to perform the audit in accordance with GAAS. When should the auditor obtain knowledge of the client? Before he begins the engagement. Why does the auditor obtain knowledge? The auditor obtains knowledge of the client for 5 reasons. 1. To identify the areas that will need special consideration in the audit. 2. To assess the condition under which the accounting records are produced. 3. To evaluate the reasonableness of the accounting estimates. 4. To evaluate the reasonableness of management's representations. And 5. To make judgments about the appropriateness of the client's accounting principles and footnote disclosures. How will you ever remember these 5 reasons? It's easy. Think about the overall situation here. The auditor's concerns are: what's special at this client? What's the condition of their accounting records? How reasonable are their estimates? How is management integrity? Or in other words, how reliable are management's representations? And finally, how appropriate are the accounting policies? Once the auditor has knowledge of the client and they have determined that the client can be audited, auditability, the audit can begin. If the audit is a first-time engagement for the auditing firm, they must make an attempt to communicate with the former auditor. The new auditor is referred to as the successor auditor. He is happy and excited about the possibility of accepting a new client. Last year's auditing firm is referred to as the predecessor auditor. He audited previous years. Before accepting the engagement, the successor auditor must initiate a communication with the predecessor auditor. Here's how it works. The successor auditor asks the client to contact the predecessor auditing firm so that the successor may ask the predecessor certain questions. There are 4 questions that must be asked. These 4 questions are always tested on the exam. The 4 questions are as follows. 1. Do you, predecessor auditor, know of any facts that bear on the integrity of the client's management? 2. Have you had any disagreements over accounting or auditing issues? 3. Do you know the reasons why the client is changing auditors? And 4. Did you have any communications with the client's audit committee or board of directors about internal control, fraud, or illegal acts? What are the key words for the 4 questions? 1. Management integrity. 2. Disagreements over accounting or auditing issues. 3. Reasons for auditor change. and 4, communications about internal control, fraud, or illegal acts. When must this communication take place? Before the successor auditor accepts the engagement. Why must the successor attempt to communicate? To decide whether or not to accept the engagement. Will the successor obtain any copies of the predecessor's work papers? They might. The most useful areas deal with the estimate and loss contingency accounts. Estimates and loss contingencies are based on assumptions. It is helpful if the predecessor assists the successor auditor by providing them with copies of such work papers. However, the choice is totally up to the predecessor auditor. One thing is for sure, the predecessor is never going to give the successor copies of all work papers, especially those dealing with budget, billing, and client staffing issues. Must the predecessor respond to the questions? Yes, unless they are currently being sued by the client. In the case of a client lawsuit, the predecessor simply states that they are limiting their response. If I were the successor auditor and the predecessor auditor limited their response, I think I would decide not to accept the company as my new client. Careful, selective auditors limit their business risk by selecting clients that appear to possess integrity and honesty.